Hey guys, please take the time to review as well as understand this disclaimer I'm going to give you. My name is Dontez Lindsay. I am the General Manager of Dux Trading LLC, as well as the lead trainer of StockCraft. I'm not a financial advisor, nor a CPA, and the content I create is for entertainment and educational purposes only. I trade in my account, and everything I do is hypothetical in nature because it doesn't happen in your account. My experience with trading is not typical, nor does it guarantee that similar results will be obtained by you. I am merely sharing my opinion with no guarantee of gains or losses in investments. Remember, day trading can be extremely risky. You should be prepared to lose all the funds that you use for day trading. In particular, you should not fund day trading activities with retirement savings, student loans, second mortgages, emergency funds, funds set aside for purposes such as education or home ownership, or funds required to meet your living expenses. Further, certain evidence indicates that investments less than $50,000 will significantly impair the ability of a day trader to make a profit. Of course, an investment of $50,000 or more will no way guarantee a success. Please take the time to review as well as understand this disclaimer. With that out of the way, let's get into the content. All right, last time we left off with the important terms that I think you should know in day trading. We went a little bit in depth. This time we're going to give you a brief description of more terms. So let's get into the video. All right, so last time we left off at parabolic, morning spike, fresh chart, and warrants. This time, let's cover from offerings all the way down to category. Now, first place we're going to start is offering. What is an offering? Well, an offering is pretty much the company is giving you shares, and they're giving you shares at a discount, or they can give you at an overpriced sale. Main thing is when the company first enters like public trading, they have to do an IPO, which is initial public offering, which is pretty much saying, hey, I'm the CEO and I own 100% of my company. I'm going to take 40% of my company and I'm going to put it out there so the public can trade it. And then I'm going to do warrants and offerings so I can take that money to pay my bills. I'm going to do offerings when the inside people that work for me, that I've given a percentage of my company out, some of them can throw their amount of shares inside of the public so they can trade. Now, when we agree as a company to take some of our shares and then put them on the public for company growth, that's an offering. So if you don't understand that, they say it a little better on Investopedia. So up here, the issue or sale of securities by a company. That's pretty much what I said, except better. And they're mostly explained in the IPO, which is the initial public offering of that. Now, offerings, there's several types. There's an IPO, there's a shelf offering, there's a secondary offering, there's an at the market offering. Main thing is they're introducing shares into the public and then they're doing it at a price. Now, the price can be whatever the company thinks it is. Now, what's really important about the offering is what kind of edge and news and anticipation does this give to the investor, and what does it give to the trader? You kind of have to know both depending on which side you're on. In my case, I like to think that when the company does an offering, they're trying to expand, they're trying to grow, and that's supposed to be positive news because they're probably trying to meet their target for earnings. They're trying to, pad their pockets, or they just pump their stocks, so they're trying to pay their bills, cut down on expenses and everything like that. At the end of the day, it's positive news. And then you can use that as a catalyst to make money on the longs, or wait till it gets to the top, wait till they did their offering and you short it. Your disadvantage can be getting stuck in the offering. Here is where Steven last got caught in the offering. This drop from $6 to $3. That's an offering. And in my case, I made a quick trade here, and then Steven, he got caught in the offering. I just know he actually got caught in like 3 offerings back to back within the same month, and KTTA was one of them, and he was very upset. Well, that's all I really want to say about offering. And this would be an example you could look up for November 24th when that happened. All right, so that was about offerings, which is pretty much introducing shares from the company's perspective so they can make a profit to reinvest back into their company. As the investor, your job is to know that that's going to gap down and then make sure you're on the right side, which is shorting it. If you're long, there's a chance you can get trapped and then lose a lot of money and can't even get out because it's similar to a halt and you can't realize your profits. Next one will be a supernova. So a supernova, that is similar to a parabolic. And so you saw before I defined a parabolic as above 200%. A supernova to me is above 300% minimum, but it is actually something closer to like 500%. A supernova is GME, it's AMC, it's all these meme stocks, these hype sectors that go up, 3 to 5 times the original price within a very short window of time. Like I'm talking in like 3 to 5 days, you've gone up, almost 1,000%. It's ridiculous stuff. Main thing is long-term shareholders, they aim to cover into known resistances. If you had a well-known company that, the fundamentals are bad, but then it became viral on social media, like similar to GME, where it became viral on Reddit, and a lot of people are seeing that hedge funds are over shorting this ticker, that can inspire a rally, because the rally and bull trends are very big, especially when they become viral, because people are stubborn. They're trying to create a movement. At one point with the GME, people start calling themselves diamond hands. And, that actually affected the culture and Wall Street like permanently. Now, I'm not saying that they have a lot of power, but they definitely made a name for themselves in Wall Street. And when it comes to supernovas, this has always been a thing. Like that 1 in 100 or 1 in 1,000 chance that a ticker can go from like $1 all the way up to 100, and everyone believes in that dream that this ticker can be it. Now that's a supernova. Like the price action is the supernova. The actual technical analysis of like that amount of range created in a very short amount of time, that's the supernova. But you have to kind of break that down to like specific situations, criteria, and scenarios. And one of those is it just happens to be the next term, which is a short squeeze. So a supernova has to start somewhere. The supernova originally was probably a morning spike that peaked, pulled back, consolidated, and then broke into a new high. And then people shorted it, it consolidated again, and then broke into a new high again. And then at that point, the cycle just keeps repeating. And eventually it got to a point where it became so big, so popular, that it's just building a reputation. This reputation became viral, and now it's a supernova. It's up 600%, 500%. It's following the trends of that year, depending on what sector it's involved with. Whatever the original catalyst was, whether it's a split, positive earnings, being attached to some political movement. At the end of the day, you just know that a supernova is a short-term trade because the fundamentals didn't change at all. It's all just an extreme amount of demand on a fixed amount of supply. And as soon as they do that offering, you don't want to be in there. And if the hedge funds are really adamant about fighting the retail, the risk is with the retail, because the big boys, they have a lot more room to push, and the chances of getting every single retail together are a lot lower. Now, with that out of the way, that's where you're getting the momentum loss. Momentum loss, that's pretty much a fancy way of saying at what range is it overextended, is it top heavy on the daily, where it's creating like double tops, where the point where you have a failed morning spike, it's heavily traded volume, and the extension or range created mixed with that heavy volume is becoming trapped at a level that will not hold the next support that it cracks. And you can start adding in more details with that, like round numbers, heavy volume, crowded volume, all terms that you have to define for yourself, which go into like categories, which, you know, we could talk about that later, but now not really that important. Once that momentum's lost, you're going to see fades. You're going to see fades that might even happen a little slowly. And that's where we get into the next term, where that's slow grinds. A slow grind is another technical analysis term that tells you resistances and supports are going to be slowly corroded. And now, why is that important? At every price level, there's going to be a resistance or a support, and you can give a metrics to that, whether it be in like dollar psychology, dollar volume, or any other indicator that just shows there's double tops or some form of resistance in that area. A slow grind erases all that, because anybody trapped in that area as a bag holder, which ultimately makes up that resistance, is slowly gone. Any kind of fear or psychological connections made to those double tops and double bottoms and in patterns and stuff, slow grinds give doubt because it's in action. And when it comes to fear, when it comes to doubt, shame, all that comes from a form of inaction. And inaction in a penny stock looks like slow grinds and consolidations. Those are the things that start the FOMO. Because when you see a slow grind and you see a consolidation, it gives you a chance to overanalyze. And once you start overanalyzing, you're going to start making stuff up. Now, we'll go to the next one, which is individual price. Now, I'm going to keep this one simple. I actually have a lot of points for it, especially like specifics in terms of like, you know, be below this threshold and like float. This is best used against float rotations and, you know, dollar block, use it in this metrics and everything like that. But long story short, on individual price, this is just the price times the resistance at that level. I can give you an example of that one. I just pull up any chart, really. All right, so with individual price, what you're gonna have is at each of these dollar levels, the volume up to that point in the day, starting from the previous close, use the volume up to that point times the average traded price at that level, and then that can give you the individual price. And this is just a metrics and dollar volume that you can use to pretty much just track how much money is trapped at that level. Now, it's not an accurate measure. It's more of, this gives you an idea of how much money is actually in the stock and gives you a weight at which, you know, momentum can shift. Because at some point, there's a certain cap to how much money can be trapped in a single stock within specific categories in the first place. And so in this case, you have ALLG. It traded 13 million at $15. If you add the amount that it traded yesterday mixed with how much it was trading today, around the like $20 area, and you compare that to your statistics measure of previous like market caps and floats of this category, you can probably figure out how much money it actually took for this stock to change its momentum around this $20, $21 area. And then we call that dollar blocking inside the Dux Trading LLC. I'm gonna leave it at that for now. There's a lot more criteria to go into that idea of like a dollar block. but I'm not going to share that on the channel right now. All right, the next one we get into market categories, float categories, and category. Now with market categories, this is pretty much from A to B. I'm going to consider this a category. And then that's going to be the market cap. Now, between market cap of like 0 and like 100 million, I can consider that a category. Between like 100 and 500 million, I'll consider that another category. That's where I'll start naming things like small, large. All right, so when it comes to these market caps, they each have their own category. And if you go to Investopedia, they'll show you how they define it. And so you have some that are in the billions, and those are the mega caps, the large caps. But the ones in the 2 billion and below, those are small caps. That's where you get into the penny stock area. Now, the stuff below like 300 million, that's micro caps. Now, in micro caps, that's actually where you will find the most volatility, because the demand down there to leverage those penny stocks into a higher price is a lot more profitable than going into the large caps in the short-term trades. Now, that's without options. I'm talking about just straight naked shorts. Now, with options, that's where you can leverage the large caps and the mega caps. Or you can actually do a legit investment. It really just depends on what floats your boat. But in my case, I just want to explain the categories. These are micro cap categories. The same idea of how these are differentiated, you can do the same stuff with float. Now, there's micro float, small float, mid float, large float. I won't say there's a mega float, because most of the time in our chat room, we like to stick to the ones under like 500 million. Even lower than that is better, because that's the entire amount of supply. And putting those in categories, you pretty much make an environment. And then once you understand what the stock looks like from the environment perspective, you can find advantages and disadvantages in terms of price action, momentum, in all kind of other categories within the environment. You just have to frame it in the way that gives you an advantage according to the pattern that you're using. That's all I'm really going to say about that. It also helps you with tracking. Now I'm done. Now, when it comes to category, notice how I said market cap category, float category, and then I just have category by itself. Now, what do I have category by itself? Long story short, you can use the word category for anything. It's just a word. So with category, I like to match specific float and market ranges to create an environment. And then I look for price action in that environment, and then track 100 samples to be accurate. Other than that, there's categories when it comes to putting it in other terms. So let's look at volume float. Now, when it comes to volume float, I like to look at volume as an emotional category in terms of, is this ticker crowded or is it not crowded? The amount of certainty, fear, FOMO, and things like that. Are people anxious? Like looking at the volume and the amount of volume trapped at specific price levels or the time of day, they can give you that sense of excitement. And that excitement mixed with inaction becomes fear. And then you can just see that just in the volume. Now, that becomes its own category. In this case, I'm only going to give you two of the ones that I look at, which is crowded and not crowded. Now, if you add that to some of the catalysts where we're talking news, let's say you have like a earnings, a merger, a contract winner, you can have all kinds of catalysts. Now, with those catalysts, it can be bullish or it can be bearish. That's just one category. It could be strong, it could be weak. That's in terms of like quality. You know, did you barely beat your earnings, or did you beat your earnings plus you have a plan for the future and you've already had strong fundamental growth mixed with the name of your company just became the same like sector or name as the previous like management or president, or like something else that makes you like viral or famous. Like it can legit be anything silly like that. After you get past that like magnitude metrics, you also get into is this affecting that stock directly, or is it more of indirectly? Like, are you a leading play or are you a sympathy play? And that's where it becomes, is it a direct influence or indirect influence? Like, is it just getting the crumbs of a trend, or does it just have a similar name to what's actually moving this stock and stuff like that? That's just the categories for news. When it comes to sectors, now that's where it goes back to secular trends. With a trend, you can be impressionable or you can be vulnerable to certain types of news. So technology by itself, technology is a sector that can, shoot up really fast, and it also expires pretty fast because the technology industry is advancing rapidly. Becoming outdated in the technology industry is pretty common. And so when you see in short-term trading, there's a large demand for something that can change within a couple weeks to a couple days to even a couple hours. But it's always going to be a strong sector in general. But the main thing is, you just want to know, is it in one of those volatile sectors, or is it more in a conservative sector? Where are we talking about financials, or something similar to a healthcare sector where you could have found the cure for cancer, or they say it's the cure for cancer until you realize it's actually a scam or a pump. Oh, you just found out there's a new iPhone release. And then it turns out that it's actually them just putting on a new attachment to the previous iPhone. It's the leading sector of that day. It's a trend. Now, with these trends, there's small trends, short trends, intermediate trends, and large trends. At the end of the day, they all have to end at some point. They're going to fall off. Something else is going to replace them. And that's where conservative trends come in, to where you got commodities, gold, things that are a little more sturdy because it's fundamentally attached to something greater than itself, like the US dollar and the 10-year bond being attached to gold, or the necessities and not only the companies that are fighting inflation with their conservative, strong fundamentals that show stable growth year to year, despite whatever scandals and changes in the trend. So it doesn't matter which category that you're trying to attach it to. The main thing is you need to sort your thoughts out and have a clear goal and understand whatever insights you find applicable or applicable and repeatable. All right, we'll end it here with the important terms in trading. If you like what you saw, please like and subscribe, and I'll see you in the next video. Peace.